Hey all, G-Money is back after the GameStop earnings call and Wednesday's price action on the GME stock. Now today, we will do some quick analysis of the stock to see if I am a buyer. Stay tuned. Paper hands and short sellers rule the day as GameStop drops over 25% and hovered around 130 a share on the day after what was probably the most highly anticipated earnings call this quarter. And I'm sure thousands of collective breaths were released as the call started. Now, basically, in terms of total revenues, and for the new home gamers, revenues basically means the total dollar amount of everything that they sold this quarter. Their revenues dropped to $2.12 billion, and to compare, a year ago that was $2.19 billion, and 2 years ago over $3 billion. So there's a clear downward trajectory, but let's look at the full year sales. This year's $5 billion for the entire 12 months. Last year it was $6 billion. So I'm sure COVID played a big role in the drop in revenues year over year. Now on the earnings front, again, for the home gamers, this is roughly revenues minus expenses, minus a few other items. But this also missed the analyst estimate of $135 a share, but it came in at $134 a share, so a penny short. So with all the bad news out of the way, here's some good news. The full year loss is $2.14 a share. The last 2 years, the losses were actually between $5 and $6 a share. So their cost-cutting measures and closing of stores is stemming the bleeding to some degree. Some more good news, their existing online sales actually jumped 191% last year. And that was actually 1/3 of their revenue. So what does this show? They have a paltry online presence right now. And they're selling games through this. And you know what? It can only grow from here. Imagine if they had an infrastructure like Epic or Valve. What would their sales be like? And talking about the online presence, analysts were livid as the call ended early and they had no Q&A. Many of the analysts were miffed as they expected to ask questions about the turnaround plan, Ryan Cohen's role, and surely many questions were going to be focused on the short squeeze and the Wall Street bettors causing a rise in the stock. Honestly, who cares? Analysts are actually paid to produce reports and to get people to read their reports, which is their product. That's where they make their money. They have no vested interest in the company unless they own the stock. So I say, let the analysts fume and expect scathing reports to come out in this next week. Look, Ryan Cohen just joined the board 2 months ago. To expect a fully fleshed out plan in 2 months is sheer lunacy. Putting additional analyst pressure on them will not help. So I say, good for GameStop. Let them sit in their war room and make great plans for the future. Now, as for me, I'm going to do my own analysis. And here's my back of the napkin analysis for this video. I went to Value Line, which is my source for good historical financial data. And I looked at the year with the best net profit, which was $403 million for that year. So I think we can apply some kind of multiple to that to get a good target price for the stock. A retailer is usually in normal stock market times around 15 PE, but nowadays Walmart and Target are between 22 to 29 PE. So if we want to assume GameStop will be a technology platform to video game distribution, we may want to evaluate it similar to an Epic or a Valve, but both of those are private companies. So we can't have any real good valuation there. Then I took a look at Netflix's multiple for an online media delivery platform, and their PE is 86. So let's take 3 scenarios: a retail scenario, a hybrid scenario, and a pure online scenario. With the retail scenario, I think I can safely apply a multiple of 25, which is higher than most retailers. This would lead to actually a $10 billion valuation, which is actually near today's stock price of $140 a share. Now, if we apply the hybrid scenario of 55 PE, we are looking at a $22 billion market cap, which is around $315 a share. With a sky-high PE of 86, a la Netflix, we are looking at a $34 billion valuation, or $493 a share. Actually, that was pretty close to one of the short squeeze highs. Let's realize Netflix is the best of breed and a leader in their industry. Their competitors are like Disney Plus, Amazon Prime Video. Their PE is going to reflect a higher multiple because they are the leader in the best in breed. Now, in video game delivery, Valve and Epic are the leaders, and GameStop is actually playing big time catch up right now. I'm a value investor and conservative in my approach, so I'm going to use the first scenario of 25 PE, which reflects that they're still a retailer, but that they're growing their online distribution. One more thing, I assume this off of their peak earnings, which they may or may not reach again. So in my mind, if GameStop goes back to December levels in their stock price, I'm a buyer. Much to the chagrin of the Wall Street bettors on Reddit, the best case earnings scenario for me at a 25 PE is already priced into the stock, which makes any profits in the future on the stock hard to achieve. Now, do your own diligence, because I don't make recommendations as I'm not a registered investment advisor. And there's a lot of noise out there, and I hope this helps you cut through it with some quick fundamental analysis. So, as always, stay frosty and invest wisely. We'll see you again soon.